Listen, I have a very, very close friend of mine lost $400,000 last week investing in startups. She invested in a company in February. She actually called me. I have to fly over. I remember it was like end of February to look at the companies. All the companies were like freaking biogenomics, some bullshit. And me being from the stock market, I know exactly what happens with biogenomics, all the healthcare. Cure this, cure that, cure X, cure Y. All the companies go to zero. 99% of the companies go to zero. And I told her, choose a company where you can invest, where you actually understand the life cycle of the actual product or service these people are selling. What was the problem? I personally didn't actually understand. There was one company trying to solve the blood pressure. There was another company trying to solve like the high sugar, type of shit. There was another company who was trying to solve like the rhythm of the heart, which was like too high or too low, or some bullshit. I'm saying this as being person on the market for so many years. I've seen companies coming out with crazy ideas, crazy proposition. This is going to happen in Q3, this is going to happen in Q4, and then the company goes bust in Q2. They're not even able to see Q3, Q4. So I told her, honestly, it's a very close friend of mine, okay? I told her, just pick a company. We understand the actual life cycle of the product or service. So you will be able to actually measure your risk tolerance, right? Your risk exposure. And he said, you know what? No, here the great thing is that the upside is unlimited. And I look at her like I was the dumbest person in the room, and I told her, do you actually understand that the actual downside also is unlimited? And she was, not so much money. The small part over here that she didn't mention is that he actually invested in 3 companies in the same niche, in the same industry, which made her to lose, as of today, around $400,000. And she was kind of depressed, and she was kind of sad. I have to fly over back to fucking San Francisco and meet her and talk to her. And here is the deal. You can make money in sectors or niches buying companies that are selling products or services that you're not fully competent to speak about or understand. Yes, you can. But this is 10% of the story. This is 10% of the cases. 90% of the cases, you are going to lose money, or you're exposed to lose money. Why? You're exposed to lose money because you cannot really hedge the market. Let me explain the whole situation. When you understand the niche or the industry, more or less, you are capable to hedge your position. Let's say I go into the AI private equity route, and it is 2008, and OpenAI pitches me. He wants me to invest $1 million. I don't know nothing about AI in 2008. But I have a friend who is investing in a company which is called Anthropic, and he put $500,000. And I know the person is very smart, the person is technical, I'm not technical. So this is how I'm going to hedge my bets. Even though I know nothing about the industry, even though I know nothing about OpenAI, I still will be willing to put $500,000 up to $1 million in 2008. For a lot of people who are not aware or weren't born that time, 2008 to 2009, Elon Musk was named as one of the worst entrepreneurs. Both of his companies, SpaceX and Tesla, were going bankrupt according to the media, and he was called loser for losing the $500 million check or payout he received from selling PayPal to eBay. This is the environment. I want to set up the realistic environment for you. The problem with my friend, which she invested in this biogenomics bullshit, live forever type of shit, she had no experience in this niche. She had no experience in either using the products or ever invested or studying or investing or looking to the whole overall niche, which is the winner, which are the winners, which are the losers, which company actually has a comprehensive advantage over others, which company have a budget actually to do the research and development and actually come up with some solution that hasn't been developed yet. She lost $400,000. She invested in February and now we're June. All of you, motherfuckers, I know exactly. You're aiming to make 6 figures this year. My friend already lost 6 figures, and it's not even half through the year. What is the lesson over here? The lesson here, I'm gonna put it as raw as possible. If you're not smart enough, regardless of what you're thinking, you might think you're smart, but in the back of your mind, you know you're not smart enough. If you're not smart enough, hate your position, meaning look up to other companies that they're doing or selling the same product or service. If they're none, stay the fuck away. If there is only one company who is selling a fucking cigarettes made out of fucking, ocean fucking grass that grows 6 times of the every 6 months or whatever, stay the fuck away unless you're a fucking biologist. People think that they're lucky. Listen, a lot of people think that people lose money because they think they're smart. No, people lose money because they think they're lucky. And what this even means, when you think they're lucky, people are willing to bet more money or to lose more money on the premise that they think that they're lucky versus on the premise that they think they're smart. People are willing to bet $100,000, figuratively speaking, on the premise that they feel lucky versus on the premise that they feel smart. On the premise that they feel smart, they're going to be betting like maybe 20 to 25 to 30 to $40,000 maximum. The other remaining 10% of the world. Be smart. You're following of the channel. This is why I'm going to give you the benefit of knowing or understanding something that I probably shouldn't even say that, right? It's no benefit for me saying this to you, but I personally feel satisfied saying this to you or sharing this with you. Which is, you need to understand what gives you the best possibility of being successful in your investment as an investor or as a founder. Which means, what do I know that other people don't? Let's say I'm into a dating business. Let's say I'm interested in launching a dating app. What my app be different versus all the Bumbos of the world and all the dating apps online already existing for the last 5, 6, 7, 8 years? My app will be different because I have dated 621 girls in New York City. So I know something that no other man knows about dating and about dating as a man. So my edge on building an app for dating will be building an app from the position as a single man who is dating in New York City, which will be a killing position, which will be a position where none of these companies can actually compete in. I don't even have to promote this on Facebook Marketing. I don't even have to promote this to the UGC platforms. They will find the app because this is a problem and I am the solution for this problem. This is for free, my friends, because I respect you. So on Friday, I spoke with a lady. She's famous. She's singer, right? We spoke last year. She actually became a billionaire, right? We spoke about investing. She has seen some of my videos on YouTube. We didn't start the conversation with financing, with investing, or whatever, but it always ends up this way.
So we talk about it with, I couldn't say, who is it, but we spoke about, what she actually did, what she actually changed. She said that she has been sitting on the almost same net worth for the last maybe 3 years. She said 3.5 years. Uh, she made a big change. She didn't change the people who were managing her net worth or her portfolio, right? But she, in fact, uh, decided to take a bigger risk. I'm not gonna go into details, but she told me what exactly she changed from to. But I'm going to say to you, I'm going to share with you what she told me. What it's like to actually be coming from a person who has $150 million to become a billionaire in 1 year. This is a lesson for risk tolerance, and risk tolerance is not something to be proud with. Right? It's not something that, hey, I'm very a risk high tolerance player. Like, it's not something like this. Risk is associated with knowledge. If you have a sufficient knowledge about something that other people don't, yes, you can take the risk because you know something that other people don't. And the people who are actually working for NVIDIA, they knew that NVIDIA is building chips that will be used by all of the AI companies. And everyone else who was outside NVIDIA as an employee was not a geek, wasn't aware that the chips was the first layer of the AI revolution. The second was, of course, the data centers. The third one, which is currently evolving, is the memory set. This is why you saw the SanDisk stock actually explodes from, low hundreds to very close to $1,000 share. But again, having what she told me that before, she had no intrinsic knowledge about the markets at all. She only knew about S&P 500, about diversification, somewhat of portfolio theory. But remember, at the end of the day, if you are investing following the average person's investing strategy, you're going to have an average returns. And there is nothing wrong with this. She could have been remain with 7 to 12 to 16%, which was the actual S&P 500 return for 2025. Every single year, moving forward. On $100 million portfolio, 16%, it's not a bad deal. $16 million gives or take, you pay 30, 25, 30% taxes on it whatsoever. But remember, there is something called time value of money. I made a separate video about it because this is something very important. Uh, it is easy concept, but sounds complicated. That's why a lot of people not really paying attention to. Don't really want about. Effectively, this is why $1 today worth more than $1 tomorrow. Time value of money, in particular with dollar, because the Federal Reserve can print as much money they needed to make the balance sheet works in a sense of the treasuries. So the debt ceiling, you probably heard this once upon a time. Every single year there is more money spent than money that needed to be covered, collected by taxable revenue whatsoever. So then the debt ceiling should be released. There is a limit. This limit should be removed. So Treasury will be able to issue more treasuries. So then the Treasury will be able to sell these treasuries to the individual or institutional investors. So then they can actually raise capital, which will be able to cover the debt hole, right? It's very simple. I understand it might sound complicated, but it's very simple. So the main concept that I spoke with this lady is that she decided to change her risk tolerance. And the people who are managing their funds, right, it's an institutional investor. I know them very well. They're pretty conservative. Even their app or their website as a broker is very outdated. When you go on it, it takes maybe 7 clicks to go to your transfer funds in and out. you can imagine how outdated the app actually is. But la- last but not least, I want you to think about this. She said that uh, the concept of her taking more risk was not motivated by greater returns. It was rather because she's into the entertainment industry. She's not into the finance. So she really cannot see or compare returns between different people or portfolios. This is something that people within the industry can see from the first hand and look at somebody else and said, oh wow, I made $20 million last year and this person made, 31, 32, $33 million. Why? We both had $100 million invested. Why this person made 12 or 11 or $13 million more than me? Right? They kind of get curious. There's always this level of competition. They might not, you know, uh, be honest and be upfront and say that this actually exists. But remember, efficiency always equals better performance. Think about the Ray Dalio's Bridgewater wealth management program. Think about the difference between having your money invested with BlackRock for the last 25 years versus having your investable income with Berkshire Hathaway for the last 25 years. It it all looks good. It all checks the box, right? Sophistication. They have counterintuitive trading algorithms, and they have analytical teams that could effectively arguing to each other. It's not easy to make the decision where the capital should be allocated to. Should we buy Nvidia or should we buy Apple? Should we sell Tesla or we should buy SanDisk? Is Microsoft really going to have an upper hand in the OpenAI deal when the OpenAI start actually running ads on their platform? There are many questions that a lot of these analysts job on a daily basis is a requisite. It's a prerequisite and requisite for their success in keeping the job and keeping the ball running. So I spoke with this lady. Everyone knows who the lady is. And she became a billionaire last year. I believe in uh, early August, she had like a special entertainment event. She said something that really blows my mind. She said that with her previous net worth of $100 million, and now when she's a billionaire, she said that the only thing that actually changed is the scale of her return. She didn't feel that she's taking greater risk because she's still not really managing or keeping up with trades or with the investments or with the hedges in the portfolio. She's not even looking through the picks of the portfolio managers, right? She's just looking at the returns every couple of months, and she's looking. It's like crazy, right? If before you had $1,000 in every month, I can give you a very simple example. Let's say you have a savings account, and let's say in the savings account, you usually had, let's say, $1,000. Every month you get like $23 return, right? Monthly interest whatsoever. But the moment comes and you actually deposit $100,000, simultaneously you are making, you know, 250, 300, $400 depending of the interest rates from the Fed, right? So it's like, wow, I didn't do anything different. I just put more money. The only difference is that she didn't just put more money, she put more money into a higher risk strategy. Because remember, at the end of the day, you could choose with your portfolio manager, with wealth management team, uh, what route you want to take upon, right? You want to take a mid risk, high risk, or excessive risk. Excessive risk is companies that are here today, everything sounds good, It's absolutely outperforming 20+% daily gains. But these companies could disappear in next month. Could show that, you know, all the reports were fake, the clients were not paying, or the product was not as good, was promoted to be good. And all companies were crashing down to the zero. Again, risk tolerance is not only investment strategy, it's a personality. I believe not only this lady, right? I know a lot of other people who made a lot of money, not because they were smarter, not because they were, I would say, very knowledgeable about subject matter or the niche. They were just taking so much risk. And they were not taking the risk because they were so bullish or confident, or they had a very uh, clear path where the project or the company is going. They just like the risk. There are people out there who cannot live without being on the edge. This might sound like a cliche, but I guarantee you there are people out there that cannot survive if their life is organized, predictable, if everything is set in order, there's no expectations for potential changes in the last minute or some potential drawbacks of their decisions, right? They just can't live in a world where everything is predictable, in a world where there are no risks, in a world where you have a guaranteed potential minimum return or outcome. So this is the lesson over here. The lady was the same lady. The invested capital was the same capital. She didn't change it. The only thing that changed was her attitude towards the risk. And don't get me wrong, she could have lost the $100 million. Uh, what was the most recent decline? Okay, the market fell in the beginning of the US Iran war around 17%. If she caught up this bad timing, right? Sometimes it's about timing. I'm going to be honest with you. Sometimes it's all about timing. You might be completely right about your investment thesis, but sometimes it's just the market is fixed. Okay, so she could have been down $17 million, but instead she become billionaire. So timing, sometimes this is the luck moment, the luck part of the equation, which I contribute to be around 10 to 20% usually, which is knowledge, capital allocation, timing, and luck. This is what actually comprises the whole equation of successful investing. But anyway, guys, I don't want to get this video too long. So bear this in mind, pay very close attention to the markets.